So check it out, I just recently sold 2 positions in my dividend cash flow portfolio. These 2 stocks were in my portfolio for over 2 years. These are quality dividend stocks with great dividend metrics. Why did I sell these 2 positions? Because my new investment is going to increase my cash flow, wait for it, by 600%. Also, remember to stick around at the end of the video because we have another Average Joe live Q&A question from my audience being answered by me. By the way, before we get started, if you had been part of my Patreon group and part of the corresponding Discord community, you would have known about all this information before today. You would have known about my thoughts on this change days before I actually did it, and you would have known about it immediately once I executed the trade. So what are you waiting for? Join me and over 350 other patrons and start improving your investing and options income knowledge today. Link in the description below. All right, guys, here's a snapshot of my portfolio as of June 23rd, so a little bit dated here, but I wanted to show you the 2 specific positions that I sold out of in order to make way for this new investment. AbbVie, ticker symbol ABBV, and ticker symbol AVGO, or Broadcom. So both of these dividend stocks have been paying dividends now for over 10 years. AbbVie paying for 10 years, although if you technically count Abbott Laboratories' streak, then it really makes AbbVie a dividend champion at over 50 years. Then we've also got Broadcom paying dividends now consecutively for 13 years. Both dividend contenders, both with great dividend growth rates, as you can see right here, near or at or above 10% every single year. Additionally, their payout ratios based on free cash flow, both of them between 50 and 60%, which is very healthy. Which begs the question, how on earth can I justify getting rid of these positions when they meet all of my dividend criteria? I've said it before multiple times on the channel, and I'm gonna say it again. You can't start investing until you know very clearly what your goals are. What are your investing goals? Why are you investing for cash flow? Why are you investing for the future? Everybody's goals are a little bit different. What's critically important to one person might be not important at all to another. I've been very explicit on the channel for my own personal goals. What's important to me, my short-term goals, especially with our trip coming up in 2024 across the country for an entire year, what's critically important to me right now is cash flow. And while AbbVie and AVGO both had great dividend metrics, they didn't have great cash flow based on the positions I held. Let me explain. As you'll notice with AbbVie, as of June 23rd, I had 68 shares, but in reality, I had pared this back a little bit in order to make way for a new position. So I actually held around $8,000 in here, around 55 shares for AbbVie. And then AVGO, you can see that the price per share is very high, $496.58. And as a result, I only held 9.645 shares with an investment value of around $47.89 as of June 23rd. Total investment between these 2 positions was about $13,000 or $14,000. Now remember, I've got 2 separate portfolios. I have my high yield dividend portfolio, which is made up of high yielding dividend stocks or dividend ETFs, such as QYLD, RYLD, real estate investment trusts, master limited partnerships, all yielding between 6, 7, 8, and 10, as high as 12%. And then I have my core dividend portfolio where I am hyper focused on cash flow by utilizing dividend stocks, yes, but also by optimizing with covered call strategies by selling call options on these existing positions. And the truth of the matter is the big gap here was in order to sell a covered call and be fully covered, I need to have at least 100 shares of a position. And the reality was with AbbVie and with Broadcom, I was not going to be near 100 shares anytime soon. And when we look closer at AbbVie, right here, we notice that while the yield is currently 4.02%, and again with AVGO, the yield being right around 2.97%, with AbbVie, my position had an estimated annual income of $325.48, and for Broadcom, only $158.18. This equated to a total estimated annual income of $483.66. Now that's not terrible for cash flow, but there were better opportunities to be had. So I had about $14,000 here with this position, and I'd also just come out of a Starbucks call that had been assigned, and so I had received another $8,000 back in exchange for selling that position, which I had to. So how exactly do I 6x my cash flow? How do I go from $483.66 to approximately $3,000 a year based on a change in investment? Enter the Russell 2000 Exchange Traded Fund, ticker symbol IWM. The iShares Russell 2000 ETF has a current price per share of $192.82 at the time of this filming. Specifically, this investment seeks to track the investment results of the Russell 2000 Index, which measures the performance of the small capitalization sector of the US equity market. So instead of seeing companies like Facebook or Google, Bank of America, Coca-Cola, large, huge companies, we're going to see a lot smaller companies. Companies like Biohaven Pharmaceuticals, Shockwave Medical, Chart Industries, South State Corporation, Texas Roadhouse. Many companies you've never heard of. And the Russell 2000 does pay a distribution or a dividend. Their annualized distribution yield, 1.2%, which equates to approximately $2.24 per share annually. Now, based on owning 100 shares of this investment, that would equate to dividend income for the year of $223.68 approximately. So I get what you're saying here. Hey, Joe, you just flipped out an investment that was yielding over 4% and nearly 3%. For one that's yielding, 1.2%? How does this increase your cash flow? That's because we're now selling options. Some of the biggest benefits to selling options on an exchange-traded fund, a major index such as the Russell 2000 or the NASDAQ 100 or the S&P 500, is you have significantly more volatility and volume and liquidity. With many dividend stocks, and many stocks actually, you're really only able to sell calls on a weekly basis and maybe even monthly if there's less volume. But with these larger ETFs, you have the ability to sell options up to 3 times a week because we have expirations generally every 2 to 3 days. As you can see here, we've got expirations on August 10th, 12th, 15th, 17th, 19th, 22nd, 24th, 26th, whereas normally you'd only see the 12th and then the 19th and then the 26th. So while I only generally sell weekly or monthly options, I have the ability here with this ETF to sell much shorter expirations, and which increases the likelihood that an option is going to expire worthless. Here's an example out of the portfolio right now. I've got the IWM position in my portfolio. I sold a new call option expiring on Wednesday the 10th. My cost basis in the position was $194.47. I sold an option $4 out of the money, expiring in essentially 2, maybe 2.5 days. You'll notice here that while I received $51 in premium for those 3 days, and after just 1 day, this screenshot here was taken in the after hours of Monday, because of just the option going a little bit down in value, but just time eating away at the value of the option, it's now worth only $18. And I have the ability to do this and replicate it over and over and over again. I sold this specific option with a 20 delta. Now in theory, if I were able to sell this option 3 times a week, and it worked out all the time, which I know that it wouldn't always work out, but hypothetically, if I were able to do that 3 times a week and 52 weeks a year, that could potentially yield somewhere in the range of $7,000 to $8,000 in cash flow. But I figured it'd be better to be more conservative here. Let's just go ahead and look at just selling weekly options with this position. Looking at the option chain here for IWM, let's just say we went out to an option expiration of 6 days, okay? August 15th, 2022. We're looking at the calls right here. Let's go ahead and go down here to a 20 delta right here. And that's a $198 call expiring in 6 days. And we can get right now $57 for that option, which controls 100 shares. $57, let's take that 57, we'll multiply by 52, and that gets us $2,964 in estimated annual income. Now, during that time frame, option premium could go up or down, could get assigned on some shares, so there are some things that could fluctuate there, but the reality is the ability, the potential to nearly get $3,000 a year in cash flow just based off of weekly options, knowing that the potential is there for selling multiple times every single week, tells us that this is a great opportunity. And potentially, if you compare $2,964 and we divide that by the $483.66 a share annually we're receiving from the 2 other investments, that puts us at over a 6x return with respect to cash flow. And again, I'm selling out of the money call options, so I am giving myself a little bit of room for growth as well in the underlying investment. I recognize that selling options is not for everybody, that some people just want to keep it very simple. And when it comes to that, and especially based on your own unique goals and objectives, as well as your own specific situation, you might be just fine with investing in quality dividend stocks such as AbbVie, such as Broadcom, Coca-Cola, other quality dividend stocks that meet all of the quality metrics here. But if you're looking for a little bit of extra juice, if you're looking for ways to maximize cash flow, for now and in the short term, or especially in your retirement account where you have the ability to do all this without any taxable events, then selling covered calls is a great way to do that. All right, guys, time for our Average Joe Investor live Q&A. We've got a new question, and this segment is sponsored by Moomoo. With Moomoo, you have a comprehensive and intuitive trading platform. You have the ability to create a paper portfolio and paper trade your investing strategies before you use your own money, and identify the perfect types of stocks you want to invest in, whether it be dividend stocks or growth stocks. You can even compare different stocks against each other, looking at their current price per share, their market capitalization, their valuations, analyst ratings, etc. And for a limited time with Moomoo, you have a special welcome introductory bonus. Get up to 5 free stocks. 1 stock for just opening up a brokerage account, as well as an additional free stock for depositing $100 or more, and additional 3 free stocks if you deposit at least $2,000 or more. If you want to get started with Moomoo and get access to these 5 free stocks, check out the link down in the description below. Today's question comes from Josh. Let's go ahead and listen to his question.
Joe, I'm a new investor. I've been investing for about a year and a half now. And my question is, should I focus on the stocks that are the cheapest at the moment during the recession, like T. Rowe Price, AVGO, those kinds of dividends, or should I focus on the dividends that are closest to 100 in my portfolio so I can start selling covered calls quicker? Thanks for your channel. It's been really helpful.
Josh, thank you for the question. It's a really great one. And ultimately, I think it's going to depend on your unique preferences and goals. I feel like I start every answer with that, but it really needs to start there because what you're presenting is the idea of buying value, right? T. Rowe Price, Best Buy, stocks that are yielding almost twice what they are usually yielding. So we're getting good value with those types of stocks versus being able to maximize or quickly sell covered calls and maximize cash flow from that perspective. And honestly, it's going to come down to what your most important objectives are. If your goal is to maximize cash flow right now, if that's your biggest objective, then I would say if you had to choose between these two strategies, you'd want to lean towards being able to sell options, especially if you're doing so in a retirement account where you don't have as many taxable events. In a perfect world, we'd be able to utilize some of these value stocks like Best Buy, T. Rowe Price, others that have really great yields right now that are also have a lot more volatility and generate more option premium. So get the value and also be able to sell covered calls. But the reality is for many people, it's difficult to do both things at the same time. So if your focus is more on getting value, real long-term holdings that you just want to hold in the portfolio forever, you're not so much focused on cash flow right now, then I would say focusing on high value stocks, dividend stocks, would be the best objective right now. However, if cash flow is more important than getting the deep value right now, then I would say that you'd want to focus more on finding dividend stocks you can collect and accumulate 100 shares and then be able to start selling covered calls. I appreciate you being part of the community, Josh, and I'm glad you've learned quite a bit so far. If you have a question for me that you'd like to ask that I can then answer on a future video, make sure to click on the link down in the description below for SpeakPipe. Leave me a voicemail. I will respond to your question, and it will most likely get aired on a future video. And again, if you want to follow along for my own positions and be part of the dialogue that happens in the Patreon community, specifically in that Discord community, make sure to check out the link down in the description below. We have great conversations going. We share each other's successes and failures. We talk about what types of investments we're making right now. Lots of great ideas bouncing around, so make sure to don't miss out on that if that's something that you find value in. Make sure to leave your 2 cents down in the comments below. I read all the comments and I love getting your guys' feedback. That's all I got for you guys in this video. Have a great rest of your day. And please continue to stay healthy, both physically and financially. Have a good one.